Slippage is something that's important for traders to understand and be aware of, but most traders neglect it until it's far too late and they've already been negatively impacted by it. Now, if you want the short explanation, slippage is basically when the price that your trade is executed at, so the price that you get on the trade, is different to the price when you placed your order. But I think it's really important to understand what's actually going on. And for that, we need to start with a basic understanding of market order types. Now, there are two broad types of orders in the market. The first is a limit order, and this is where someone is saying they're willing to transact at a specific price, and either their trade gets executed at that price or it doesn't get executed at all. So it's that price or nothing. So for example, if I want to buy an asset at 1.0352, I might use a limit order. Now, if the price hits 1.0353 but never quite reaches 1.0352, it's likely that my order won't get filled. So either I'm getting in at the price that I stated, 1.0352, or I'm not getting in at all. Now, limit orders sit in the order book in the market, and they provide liquidity to be traded against using the second type of order, which is a market order. With a market order, you're basically saying, I need to transact right now with whatever price I can get filled at. It will transact against the limit orders in the order book and take whatever liquidity is needed to get filled at whatever price that ends up being. So there's a relationship between limit orders and market orders, but there's also a big difference. Limit orders prioritize the price that the transaction happens at over the timing of it, but market orders prioritize the immediacy of the transaction over the price that it happens at. So even though that's just a brief explanation, that should already give you an idea of how slippage might occur. So if the price is at 1.0352 and I execute a market order, it might be that there's not enough liquidity at that price to fill my order. Now, this might be because my order is huge, or it might be because there are other market orders at the same time taking up the liquidity. As a result, maybe I get filled at 1.0355, which basically means that I have slippage of 3 pips. But if I'd used a limit order at a specific price, I wouldn't have had that slippage. Either I get filled at that price or I don't get filled. So with this in mind, slippage is going to be worse during times when there's a lot more imbalance between the volume of market orders and the amount of liquidity in the market for those market orders to transact against. And this is more likely to be the case when there's some sort of disruptive event or news impacting that particular asset, because in those moments, more people will be placing market orders, and it's also at the same time very likely that a lot of the liquidity will be pulled out of the market, therefore creating an imbalance that will lead to more slippage, as the price will need to move further, taking up more of the liquidity, and there's more chance of the price that you get executed at being different to the price when you clicked to enter the order. So there are two main ways that slippage becomes a problem for traders. Firstly, there could be minor slippage on many different transactions, maybe every transaction, and on their own these amounts might not seem that noticeable, they might not seem like a problem, but over time these small amounts will accumulate into something much bigger, and that's going to eat into your profits. So if your trading approach can be just as effective with limit orders, that might be something to consider to avoid that slow accumulation of slippage eating into your profits. It can also be the case that when you're backtesting a system, the performance that you see is different to what you see in the live markets because of factoring in that slippage or forgetting to factor it in when you're doing backtesting. And this is especially true in automated trading systems. Many times it looks amazing when you do the backtesting, and then in the live markets it's very different. And the second way is much more damaging and often catches traders off guard. And this is when an unexpected event disrupts the markets, like a geopolitical issue, economic data that has hugely missed expectations, a natural disaster, and so on. Now, when a trader tries to exit a trade that they have open during those disruptive moments, they may have bigger slippage than they thought possible. This can especially be the case during extreme events like a flash crash, where the difference between where you think you're executing and the price that you get filled at is hugely different. So in those situations, traders believe that their stop loss will protect their downside, but a stop loss can still experience a huge amount of slippage in those moments. You see, a stop loss uses a stop order, which is like a mix of a limit order and a market order. You place it in the market at a particular price point, and when that price is reached, it actually executes like a market order, meaning it will transact at whatever price it can get filled at. This to make sure that you do actually get out of the trade, because if it was a limit order, maybe it wouldn't get filled. So the key things to keep in mind to avoid this sort of extreme slippage is, first of all, to avoid trading minor, low liquidity assets, unless you really have to, if it's part of like a bigger opportunity that you've identified. Instead, stick with major markets that have a lot of liquidity. Always know when there are scheduled disruptive events, like earnings reports for equities or the economic calendar for forex trading and things like that. And then make wise decisions for your trades in those moments, considering the potential issue of slippage. And this also goes for sort of periods of time where you know there could be unexpected news, like for example when there are wars going on or when there was the pandemic, things like that, where sudden headlines could move the market completely in a completely different direction. And make sure you don't have these huge position sizes that could lead to ridiculous losses that get out of hand if you experience slippage. So for example, scalpers who try to catch just a few pips and therefore have huge position sizes to make those few pips extra profitable, eventually they'll get caught out with slippage and they can end up in a really bad financial situation, because the slippage ends up being far more pips than what they plan to take as a potential loss on the trade, and with the huge position size, it ends up eating into their account quite a lot and they can go into some steep drawdowns. If you want more free training and free resources to help you learn to trade the right way, check the description box down below for the links, and thanks for watching. I'll see you soon.